Wednesday, October 11th, 2017, Monaco 64, home of alternative economics and contrarian views. So it's almost 1 p.m. London, so I'm a little later today, but not much to report so far. I want to talk about the stock market, and I made a video. I think it was back in May of this year, and it was entitled "Panic Up and 50,000 on the Dow," says Lindsay Williams. So Lindsay Williams did one of his videos, and I think I bought it a few months ago back then, and I went through it, and he said that according to his elite friends or whoever he talks to, that they're gonna let the stock market go, that we could even get a melt up or a panic up. He called it a panic up, Dow 50,000. And he didn't mean it right away, but maybe in the next year or two. And the reason why I'm talking about that is because you're starting to hear more about the stock market, like a melt up. For example, there's a CNBC story this morning. It says a melt up is likely gripping stocks, and its demise could resemble the 1987 bust, Yardeni cautions. He's a famous analyst, economist. I think it's Ed Yardeni. I'm not sure what his first name is. But personally, what do I think about what's going on with the stock market and asset prices? Well, I think for the U.S., it's something that we've never seen before. And that's why people have been so wrong about, oh, we're going to collapse, we're going to have a crash. And why do I say that? Well, because we've had this unprecedented policy from central banks, of money printing or quantitative easing since 2008. I know the U.S. has stopped. The Federal Reserve has stopped. They started raising rates, and they're talking about now unwinding. They're going to start unwinding the balance sheet. They're not going to reinvest the balance sheet. But just to give you an example, the Fed's balance sheet used to be $800 billion just before the crisis in 07, 08, and now it's $4.5 trillion. So that's how much money they printed. But that's all gone through the financial system, through the banks, and into the bond market. And that's the problem right now. You see, we've got a Fed put, or you want to call it a Bernanke put, or a Yellen put. It doesn't matter, or even a Greenspan put. Back in the days when Greenspan had his puts, it was in the short-term rates in the bond market. So the balance sheet wasn't as inflated. And so he could take out the punch bowl, so to speak, by raising rates. And it didn't affect the bond market too much, even though it did sometimes. Like I remember back in 1994, I was already working in the city, and there's a huge, massive government bond market bear market because Greenspan decided it was time to take away the punch bowl. What you have to understand, though, is that the balance sheet of the Fed and other central banks now don't only include like short-term treasury bills, like 1 month, 3 month bills, which they usually used to use and didn't affect too much the overall bond market and stock prices. But now they've kind of crossed the Rubicon by buying, mortgage-backed securities, longer-dated treasuries, corporate bonds. So I don't think the Fed has a way out, nor do other central banks. And I think that's what the markets and investors subconsciously have kind of, discounted into their actions. And that's why the stock market has gone up. They feel that government bonds will be trash because either way, it's going to end up badly. If the governments, if central banks don't rein in the liquidity, they're going to keep printing and pumping, because in our fiat money system, mathematically, you need to keep it going, or else it crumbles on itself, because the existing debt cannot be paid off because it's so huge. So governments have to issue more debt to pay existing debt that's maturing. They don't have the money to pay off creditors, and they don't have money to pay also something called a coupon, which is something probably people don't even remember that much in the zero interest rate world. A coupon is basically the interest rate or the income that you get paid semi-annually for treasuries, and for other government bonds mostly annually. So what do you do in such a world? Well, as a big investor, you know that that bubble in government bonds is going to come to an end. But then you might ask, what about the bubble in stocks? Stock valuations have only gone up because, a lot of big corporations throughout the world, they've been able to borrow at zero or sometimes even negative and buy back their own shares and improve their earnings artificially, because the denominator, the number of shares, have gone down, and the earnings might even have gone down, but per share they've gone up, and that's why stock valuations are this high. The other thing that could be happening is a complete loss of confidence in central banks. And what do central banks issue? They issue the fiat currency. So if you lose confidence in central banks, you lose confidence in the currency. When you lose confidence in the currency, you try to get rid of it as quickly as possible. That leads to hyperinflation. Hyperinflation is not like a cost push event. It's a loss of confidence event. But even then, you might argue, yeah, the paper will be worthless, the government bonds, but at least if I buy shares in an industrial or productive company, a technology company that's going to be around for a long time, even if the value of that company crashes from where it is, at least you will hold something that produces or a business. While if you hold government bonds, you won't be, it will be totally worthless if there is hyperinflation. So it's difficult to say, very difficult. I personally, as I have said before, yes, have some exposure to the stock market, but also protect yourself. And how much you protect yourself percentage-wise with physical gold and physical silver is up to you. It depends on your circumstance and whether you have a good job, whether you're retired. So it's basically use your common sense, which is easy for me to say, but yeah, so I just wanted to touch up on that, the melt up or panic up, as Lindsay William calls it. I think it. Are we near 50,000? No, but we are at 22,000, almost at 23,000. And this is amazing. We've had the lowest volatility, I think, ever in September, and October is becoming, it looks like it's going to be the same unless something really happens out of the blue. So let's have a look at the markets early this afternoon in London. So it's 1 p.m. now. Exactly. Spot gold is continuing to rally a little bit here after yesterday's close, just below 1290. We're at 1290.50, up $2.50. The high yesterday was 1294.50. So if you remember well, earlier in the year, 1295 was like a double top that we broke through. Eventually, earlier, 6 weeks or 2 months ago, I don't remember exactly, and then we went all the way to 1360. We've come back down. The low's been around 1260 last Friday, and now we're coming back up. So I don't have to tell you, 1295, that's the key level now. Silver, 1716, up 6 cents. So both gold and silver up almost 1/3%. The Dow actually is down, but only 15 points. Even if it was down 150 points, that wouldn't be huge. You know, I remember when the Dow was at 9 or 10, you had days where it was down 150, 200. Yeah, that was big. Now, really, the Dow to be down 1.5%, you have to see 300-point losses. And when was the last time we saw that? And that was beginning of 2016. So nothing really happening right now in the stock market. Currencies, you know, the dollar is a little stronger against the pound. Pound is down 10 pips at 131.92, so not much there. Euro's a little stronger, up 25 pips, 118.32. Not sure, you know, this thing about Catalonia is still up in the air. I think the leader of the Catalonian government kind of put the Declaration of Independence on hold, but the central Spanish government is not sure what's happening. So it's all a bit up in the air. It seems to be, I would say, looking a little better for Spain to remain still as it is now. So it looks like Catalonia might have some problems declaring independence. So we could see the euro rebound. Dollar down 0.25% against the yen at 112.16. So right near the lows. 112 will be a key support here, only because it's a big figure, really, I would say. So yeah, that's what's happening this morning. What can I say? As Keynes, John Maynard Keynes once said, and it's one of the things he said that makes sense, you know, markets sometimes can remain irrational longer than you can remain solvent. So, you know, people who have been trying to short the stock market, it's been a losing game right now, and it costs usually to be positioned short. You know, if you buy put options or if you short stocks, you got to finance that. So there is a limit. And when you buy put options, they expire. So your timing has to be perfect. So the best thing, you know, for being short is actually having cash. I know cash might be trash in the future, but it's still cash. Or precious metals, which is, you know, physical gold and silver, which is the ultimate form of cash. Because if you remember well, from what I've told you before, the banknotes that we have today, they're only representations of real cash, of physical gold and silver. So one way to be short is to have firepower. And if the market does collapse, you might not make money on the way down, but you're going to be able to, you're going to have the cash that will be able to buy a lot more down here, and you don't have a counterparty risk of, you know, for example, people who shorted the market and they had an account with Lehman. They made bundles, but then, you know, their account disappeared because Lehman went bust, or Bear Stearns. So that's all I've got to say for now. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com, the social media platform based on the blockchain, which I really think has a good future. And also follow me on Twitter. And I'll talk to you later. Bye.